Hello and welcome to KYC. KYC, Know Your Company, as the abbreviation is. It's a brand new show on NDTV Profit. In the fast-paced world of stock markets, investors are bombarded with information. But what we do in this one is we dive deeper into companies, give a comprehensive understanding of companies, and that we believe is more relevant for investors to understand. Know Your Company is a show designed to give regular investors powerful, actionable insights into the fundamentals of single NSE listed companies every day. And this is, of course, a daily show. Today, we're going to cover the company Prestige Estates from the real estate pack. It's the first time we've picked a real estate company, and therefore, breaking this down is going to be ever so interesting, and we're going to have the management towards the latter half of this show. What does Prestige do? Well, it's a diversified business model, and it covers or it operates various segments of the real estate, the industry as a whole. You have residential, office, retail, and hospitality, all of which Prestige does and has always been doing. They've completed 300 plus projects based out of Bangalore to start off with, but thereafter they've diversified. But 300 plus projects spanning a developable area of 180 million square feet. They have 56 ongoing projects across segments with a total developable space of around 86 million square feet. That's how it's currently placed. In terms of where geographic sales is concerned, that's your distribution mix, skewed towards Bangalore, as we did suggest. There's also Hyderabad, now Mumbai, contributing nearly a quarter of the sales of Prestige Estates. It will be great to also understand how they are evolving this. I want to quickly mark out the stock of Prestige if we can. And the way in which it's moved. Over the last 3 years, of course, it's been a 4x. But when you're looking at the last 6 months, the stock is down roughly 15% thereabouts. Year to date, it's given a 47%, very healthy return. And the 1 year as well, looking very healthy. It's nearly 56% in terms of its returns. It's been a 5-bagger in the last 5 years, and it's created tremendous wealth. In fact, when I'm looking at the December 2011 stock price versus now, the stock is up 24x. So in the last 12 to 13 years, it's been a very, very solid multi-bagger for investors. Now I want to bring on board Anushi first off. These are some of the parameters that we're going to cover. Anushi, of course, is the analyst with regard to real estate. So she'll help us break down all of these parameters, and thereafter, we'll have a Q&A with the management as well. So let me first start off with the first parameter, Anushi. Talk to us about operational metrics. How does Prestige stack up on that count?
Absolutely, Harsh. So instead of taking the usual income statement check for real estate, it is important to focus on the key operational metrics. That is in terms of the launches that they're doing, the pre-sales figures. So if you see, Harsh, you mentioned about that Prestige Estates has been a multi-bagger in the last 3-4 years. A lot of it is attributable to the kind of growth it has seen in FY22, 23 onwards. If you look at the new launches, FY23, 26.4 million square feet of launches, which is almost from that figure, we are seeing 40.2 million square feet of launches in FY24. However, H1 started on a muted note, 10.1 million square feet of launches. A lot of factors playing into this. One is also the election impact that we've seen. Along with that, lack of approvals. This has been one of the biggest factors due to which there have been a shift in the launches as we speak. This is also reflected in the pre-sales number. From what was the FY23 pre-sales number of almost 13,000 crore, that increased to 21,000 crore, and H1 that stood at about 7,052 crore. So we are looking at a downtick of around 36% on a YOY basis, that is on their pre-sales growth. So this is how the pre-sales has panned out on because of the lack of approvals that has been seen in not just the Bangalore market, but overall the residential market as well. collections, if we look at 9,806 crore, which has increased to 11,000 crore, and this first half we've seen about 5,653 crore worth of collections. That is about a 5% growth that we are looking at. However, average realizations, if we see, that continues to remain on a healthier note as seen in the last 2-3 years of fiscal as well, strong growth trajectory. But will they be able to sustain this? If we see in the apartment, villas and commercials, we've seen about a 26% of a growth in the average realization, with rates touching the 13,000 square feet of base as well. And even in the plotted business, they've seen about a 7,200 square feet of a realization, which is again a 49% of a growth. So strong trajectory in terms of realizations. But what needs to be focused on now is the launch trajectory going forward for the next half, as well as the next 2 to 3 years outlook, and the pre-sales number also. But Harsh, let's also see how the balance sheet pans out with the company.
Well, yes. So let's look at the balance sheet. Let's break it down. First off, with regard to shareholders' equity and some perspective here, they've done a QIP in the month of August worth 5,000 crores. So while this balance sheet is obviously sizable for a 76,000 crore kind of market cap company, but keep in mind that 5,000 crore of this has been raised at roughly a 5 to 6% discount to current market price. That's the math. To current market price. So it's been done at 1674 rupees per share, 5,000 rupees of fundraise. That's how it's playing out. Now, in terms of debt, 12,000 crore, nearly 13,000 crore of debt, but the debt to equity has shrunk obviously because you've seen equity component within this debt to equity ratio go up sizably as a result of the QIP, which is why your debt to equity looking reasonable. Now, cash and bank balances, no surprise, they've just raised 5,000 crore, 4,880 crore sitting in the cash and bank balance. They are also, in part of the QIP, they were planning to reduce the debt. How quickly will that happen? We'll probably quiz the management on that. 1,000 crore is what other investments are currently lying in the balance sheet. This number stood out for me, so I added it as part of perspective. And you're also seeing inventory worth 26,370 crores sitting in the balance sheet as of H1 FY25. So that's a sizable number as well, given the market cap and given the debts. I thought this was a relevant metric as well. But Anushi, cash flows, how's it playing out over the last at least couple of years?
So I'll give the perspective on the last 2 periods. FY24, we've seen cash flow from operations. This was around 5,500 crore of a mark. In H1 FY25, we're looking at a 2,300 crore of a mark for in terms of cash flow from operation. Net cash flows also 1,181 crore. This was the FY24 figure, which has increased to 2,316 crore as of H1 of FY25. But it is the outlook forward which is very interesting for the company. Now, if we look at what Prestige has done, that in in FY24 also they've recorded quite a strong trajectory in terms of their bookings and pre-sales. They continue to maintain this on a very high base as well. 20 to 25% growth is what they're staying in their bookings, which roughly translates to about 24,000 to 25,000 crore of sales value for the company. And this is within EBITDA margins of around 20 to 23% that we are looking at. So what is the emphasis is how the H2 is going to pan out, because a lot of launches waiting and bunched up in Q3 and Q4. But let's also see the return ratios, because as an investor, that is what the important metric is, right?
Yeah, 20% plus in terms of return ratios, Anushi. So healthy in that sense. You're seeing good ROE, good ROC. And it's been consistent in terms of the feature that Prestige Estates is able to clock good return ratios, and therefore clearly a thumbs up, at least for me, on this one. But really, in essence, Anushi, what really stood out for me was with regard to the guidance and whether they can meet that guidance, and that is something that will possibly be on the street's mind. With regard to shareholding though, because that's a key metric, how much do your current promoters own, or how much skin in the game do current promoters have, Anushi?
Well, promoters continue to stay heavily invested in the company. We are looking at a 61% of a stake in terms of promoters. Foreign investors constitute about 19% of the stake, and domestic institutions about 17% of a stake. So healthy numbers in terms of promoter holding for the company. Public holds about 3.2% of a stake in the company. Do note promoter number has gone down because of the recently concluded QIP which has taken place, but overall healthy trajectory in terms of shareholding pattern as far as that goes as well. But considering the street cred, Harsh, in the beginning you just gave us a little bit of perspective, but let's understand deeper what's happening in terms of the stock performance of the company as well.
Yeah, let's pull that one up. So street cred, we've kind of clubbed the dividend along with what kind of returns that shareholders have got. We've covered this, don't want to delve deeper into it. The street cred is quite strong. They've given very good returns to investors over pretty much the medium to even the short-term kind of period, except the 6-month period where it's been negative. And there you go, the dividend yield is absolutely zero, but for a 20% ROCE company, I don't think there's too much to complain about for investors. But in terms of coverage, what are analysts suggesting, Anushi?
So in terms of, if you look at the street coverage, this is more on the buy. So for this is according to what has been pulled up from Bloomberg. We are looking at 16 buy calls, 0 hold calls and 4 sell calls. So overall a neutral mixed picture of a scenario that we are seeing in terms of analyst recommendations. This is with a return potential of around 7.9% that we are seeing as per analyst as to what the consensus is. So this is the overall picture on the street coverage.
Yeah, hence the rally in the stock price, right, Anushi, and hence that upside doesn't look very, very enticing, at least the way in which markets are currently going. But let's quickly come to a summary of everything that we've spoken about. The income statement, H1 has been a soft one, and therefore that thumbs down that we're forced to give. But you know, maybe some commentary, if it were to be good, the guidance, if it were to be good, and if that were to play out in H2, that may well change. But otherwise, balance sheet solid, your cash flow also looks decent. You're seeing good and very strong and robust guidance from management. Let's also talk about return ratios. Clearly a thumbs up, 20% plus your shareholding, 60% plus held by management, no concern there. Again, Mr. Razack has literally built the business out of scratch, and therefore really commendable the way in which this business is being run. The street cred is also solid, very good medium to long-term returns that the stock has given, and there's decent coverage, but the upside does not seem extremely high. So we rate it currently at 6.5 out of 8, which is one of the highest ratings which we've given. But that's how we sum it up. But let's delve into SWOT, because let's understand strengths and weaknesses. Let me start off with the strengths before I toss it across to Anushi. Diversified portfolio, therefore risks are more diversified. Execution is strong. We spoke about how Mr. Razack has built this business from scratch and therefore knows it so well, and therefore the execution has always been very, very solid. But let's talk about some weaknesses. The newly launched products, whether they will play out, whether they will do well or not. Currently slower sales being seen, but how quickly will that turn around is something we'll have to look for. And of course there's debt. There is decentish amount of debt, which generally is the case for real estate companies. But is there a debt reduction plan? Is there a plan with regard to how debt will play out, and what kind of threshold of debt is something that the company is comfortable with, is something we'll have to see. But those are a couple of threats in case the cycle turns, Anushi.
Right. So, but in terms of opportunities also, if we are seeing a handful of now real estate, a lot of headroom for growth, which is still there. This has been spoken with the industry experts also so far. Now, along with the residential business, which already remains on a stronger footing, something that needs to be focused on is the annuity business as well as the hospitality business. Strong plans for the hospitality business in terms of the key addition that they're planning for the next 1 to 2 years. In annuity business also a 4.5x growth that they have planned out for the next 3-4 years. By FY28 they're seeing about a 4.5x growth in this perspective. Now in terms of GDV also, they're seeing about a 50,000 crore plus GDV figures in terms of upcoming launches in FY25. So that remains on a stronger footing. And what needs to be focused on now, currently they have around 70% of their portfolio in the south side of the business. But with the geographic expansion that they're planning in new cities like MMR, Delhi, Goa, Hyderabad and Pune, what remains to be watched out as how this incremental business could aid for the growth of the company forward. So this is in terms of the opportunity pipeline that we are seeing, but there are a bunch of threats also that one should be keeping in mind. Firstly, there have been concerns about labor shortages, increasing construction cost and all. So again, that needs to be something that we factor in. Along with that, delay in approvals, as we've seen in the first half of the fiscal, if this continues in the H2 as well, then FY26 and FY25 guidance numbers remains on a watch list for some of these players. So this is in terms of opportunities and weakness threats that we are looking at.
And let's get straight at it. Let me firstly welcome on board Mr. Irfan Razack. Thank you so much, sir, for joining us. Chairman, Managing Director of Prestige Group, needs no introduction. Mr. Razack, I want to start off by asking you, what's the sense like in H2? H1 has been a softer set of quarters, lots of reasons. Don't want to delve into those. Are you seeing an unwind in Q3, and is H2 expected to be better?
Good morning.
Good morning, sir.
Yes, I see that there are two parts to our business. Like you rightly said, you've analyzed the annuity business also and the residential business. Now, as far as the residential business is concerned, in the first half, we did about almost 7,700, 8,000 crores worth of top line business. Whereas the balance sheet and the P&L account doesn't reflect of what activity we do, because all our profits are back-ended, in the sense that the accounting system is that we have to account for everything on completion. Now that completion, whenever we launch, completion comes 3, 4, 5 years later. So, but the expense is front-ended. That is why you look at the overall what we call the financial reporting, and that doesn't really, it gives you a very skewed look to the overall operations of the company. But I think we believe we have about more than 50,000 crores worth of sales that we have done, which have not been actually spoken for, in the sense they haven't come into my P&L account. Expenditure has come, but the income has not yet come, because it will be only accounted once the product gets completed and also handed over to the client. That's the methodology of the Ind AS accounting system. I think many real estate companies face the same problem. And we believe that going forward, as and when some of our very large projects get completed, that will show up in the balance sheet and suddenly start looking much healthier. Now, on the operational part, yes, the sales, top line sales in the first half has been little muted against our guidance. But I think we should not look at it quarter on quarter. We are very, very confident that we had given a guidance for FY25 of almost 24,000 crores of top line sales. And we are confident of achieving that by March 25, because there are a lot of the products that are under approval, which need RERA clearance, all of it. Maybe they'll come in this month, or otherwise finally it will happen in December. And that all add up. There is a demand. There's a pent-up demand. Customers are very keen to book, but we can't book till all compliances are in place. But now we are very, very confident and sure, because most of the approvals are in the last and final stages, with the RERA being awaited. I think that quarter 4, if not quarter 3, will be the most robust quarter that we will have for the company, and will reach the guidance that we had already guided on. And I don't see any cause for concern as far as we are concerned.
Hi, Mr. Razack. This is Anushi joining in. You've mentioned about, you remain optimistic on the FY25 guidance of about 25,000 crore in your pre-sales number. Now, this is with the assumption that, launches, approvals have come back into picture. So I just want to understand that how Q2 and the second half of this year is supposed to differ. What is the kind of changes that we are seeing in the Bangalore market, which was not reflected in the H1 performance of the company? So if you can just give us a perspective on some of the key launches that will help with your growth, not just H2 of this financial year, but even the FY26 picture as well.
Now let me come to FY25. In Q3, Q4, maybe we're going to hit Q4. We've got the Prestige City Indirapuram in NCR, which now the property, the plans have been approved. We are waiting for RERA. So that may come into this quarter or may spill over to the next quarter. But that's a 12,000 crore top line revenue that is expected there, and there's a lot of traction. Only I think once we hit the market, I think the product will do extremely well. We've got the Prestige Nautilus in Mumbai, that's in Worli. Even that is expected to come in Q4. And that approval is also expected in January, and everything is in place. Even our CEC is ready. And for sure, we'll launch that in Q4. Even that will give us a huge amount of top line event sales. And then we have Bengaluru, where we've got the Prestige Southern Star and we've got the Prestige Suncrest. Now, both these have about 4 to 4,500 crores worth of top line sales that will come in. And there again, the plan has been approved. There are two stages of approval. One stage is done. The second stage should get done this week. And hopefully the RERA should come and it will come spill over to the following quarter. And then we've got Chennai, which is the Prestige Pallava Gardens. Only again, we are happy that the plans are approved. It's again a process to get the RERA number. Again, that will hit into Q4. And even there's a huge demand and there's a good traction. And that's again a 3,500 crore top line. Similarly, we've got Goa. So if you total all these up, which are the launches which are coming up, and these are the projects that were on top of my mind, which we are focusing on. And I believe that these all totaled up, and even if I sell substantial part of it, which we will, which will exceed, cross that line that we had guided for in the beginning of the year. Now, going into the FY26, it's impossible for me to list out all the projects that are there in the pipeline, but quarter on quarter, they'll keep coming in. And I believe that will also, we haven't yet worked out our numbers. First thing is to reach the guideline that we gave for FY25 and then do the math and come back with a number for FY26. But we have a pipeline, like you already put on the screen, that we've got almost 59,000 crores worth of inventory pipeline that is there in various stages of approval. And if all this comes, and if we sell even half of it, that amounts to 30,000 crores. So that's where we are at the moment.
Right. So I want to try and combine another couple of questions. One is to try and quiz you with regard to annuity. You're expecting to grow that business fourfold in the next 4 years. So what will lead to that kind of growth, and what's the strategy behind this? Is it to ensure that there's recurring working capital across cycles? What's the thought process? Second, sir, is with regard to the hospitality business and what that unlocks for you in terms of value.
The hospitality business, yes, we have at the moment 2,500 keys which are trading, and we are building another almost equal amount of keys and another equal amount of keys in planning. But that's a separate subject, and we are working on that and how to unlock value there. While coming into office, we are building a fair amount of office space in Mumbai, in Chennai, in Hyderabad, as well as in Bangalore. We already have completed one asset in Pune with 1 million square feet, and we are looking at more opportunities. Now, wherever we are building just now, if we interpolate that, and the completion dates are around FY28, 29, and that's the reason what we guided is that by which period, with all the pre-leasing that happens, and the demand for office is still good, the tape cup is good, and we should reach annual top line of 2,800 crores worth of annuity for office. Similarly, we have 3 malls which are trading, which is Bangalore South, Forum Bangalore South. We've got Forum Kochi and the Forum Rex Walk. Apart from the collection in the UB City, we are building another 10 more malls which are under construction. Either construction has started or under planning. All these by FY28 or 29 should get ready, and this also should get us an annuity of about 900 to 1,000 crores. So this is the game plan. The numbers are there, and we have the lands are tied up, construction is on, and hopefully by the end FY29, when these assets are ready, we'll try and see how we can unlock value for these assets, either through a REIT or a stake sale or whatever happens at some point of time. But we are managing the malls, and we will continue to manage the Forum brand. And our ultimate goal would be to REIT these assets separately as a retail REIT as well as an office REIT.
Okay, thank you so much. You've broken this down, in very simple terms for us, Mr. Razack. Thank you for coming in, speaking with us
My pleasure.
on this show of KYC. But that's all the time we have for this edition of KYC. Stay tuned for more on KYC. We hope you found this productive. From Anushi, myself, everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side.